Welcome back to Watch Your Business Morning here on Channels Television. We have celebrated especially the first quarter results from the market. Capital importation, we saw a jump quarter on quarter. Well, year on year, it did drop. And we saw the equities markets perform really good and impressive and still doing good, even though in the last couple of days, I think 2 days, we've seen a huge amount of profit taking from the market, an expected cycle going in the market and dealing with investor sentiment. But what does this tell us about what to expect in the second quarter? We have joining us for this conversation Babajide Atolagbe, portfolio manager with Afrinvest Asset Management, joins us virtually from here in Lagos. Thank you so much, Mr. Atolagbe, for your time this morning.
Hi, good morning. Thanks for having me.
Good to have you. So we saw a jump even before the elections were concluded, because the capital importation we saw was for the first quarter, and that was January, February, March. Election ended in March, the last election we had in March. So it seems even before the president took on and all of that, investors already had anticipated positive sentiment around the market. So how can we explain that? Is it just the fact that an old administration was going off? I thought that was supposed to be a time of uncertainty.
Yes, you're right. Like you rightly mentioned that at the start of the year, we saw some interest in the markets simply because investors were preparing for a new financial year, and we saw optimism around the fact that the capital market was expecting the new administration, and we had a sense that whichever candidate emerged as the president, all the three candidates had pro-market views. So that informed the market that irrespective of whoever is on board, Nigeria is likely to push and promote policies, and that would actually lead to inclusive growth and also drive capital market participation to the optimal point. So that was what was responsible for the interest we saw prior to the election. And of course, after the election, we saw that interest also doubled. I recall that the Nigerian stock market had gained 7% in the first quarter. But in the second quarter, after the election, it gained additional 12%, taking the year-to-date to 19%. And this was largely on the back of optimism around the new policies that were being dished out by the current government, and the fact that investors are now beginning to discuss potential investment back into the Nigerian capital market, given the fact that the new administration is actually sending out a blank sheet to investors to come and participate in Nigeria.
So for the equities specifically, we saw that in the first half, there was a 20% market return. What should we expect in the second half?
Yeah, I mean, going into the second half, we expect to see the momentum to continue simply because, typically in the global environment, we're having this risk on sentiment, given the fact that most of the factors that affected investor sentiment globally are already fading out. Speaking of inflation in the US, which has moderated to about 3%, and the fact that central banks across the world are beginning to rethink their position on interest rate hikes. So all of this global sentiment has pushed investors out there to begin to take risk position in emerging markets. So from the global perspective, we still think that we are likely to see more foreign participation in the Nigerian equities market because global risk sentiment are increasing. And from the local perspective as well, local participants are still likely to push more interest, given the fact that inflation is currently running at a very high rate, and the yields in the fixed income market are not necessarily attractive as we speak. So we're likely to see more interest in the equities market on the back of low yield in the fixed income environment, as well as improved risk on sentiment, given the way the current administration has dished out pro-market policies that are likely to change the tides of the Nigerian economy, and obviously stocks that are listed on the market are likely to benefit from these policies, and their margins are going to be better. But there are some downside risks that are attached to this, because now we see inflation spiraling on the back of higher food prices, and also the pass-through effect of the increase in PMS prices. So this is likely to affect the profitabilities of some bellwether stocks, given the fact that not all of them are likely to pass on this cost to consumers. And when we begin to see companies taking in some major hits in terms of high cost pressures, it affects their bottom line, and of course that goes into how these companies are being valued. So the inflation that is on the rise, coupled with some other infrastructural challenges that were still going on, are still likely to affect, or these are notable downside risks that could affect the market gaining positively towards the second half of the year.
So another downside of this positive news is that fear, this portfolio investment has been described as hot money. So any news breaks now, it's easy. They just pull it out, and we know the risks that presents, to the market. Is there a way we can make it more stable to translate it? I know there are different types of investment. Is there a way to make it spill over to direct investment, which is more stable and more predictable, for the economy?
Yes, you're very right. Excuse me, the foreign capital importation is broken down into foreign direct investment, foreign capital foreign capital investment, and other investment. But largely, we've seen that capital importation into the capital importation to the capital market is known as hot money, and it gives the country some high susceptibility to external vulnerabilities, and if that happens, the country might begin to experience some short-term problem. And the right thing to do is not to chase only capital importation through investment in the capital market, but to channel or to try and attract investment through other means, such as foreign direct investment, right? Because foreign direct investment are much more medium to long term, and investors are actually going to come in with a lot of capital, make use of the available labor, and also develop the infrastructural base of the country. So in terms of attracting capital into Nigeria, it speaks largely to it is a responsibility of the federal government to push for that, and they are likely to push for that through rolling out market-friendly policies that would allow investors' confidence to increase, so that they can find comfort in playing in the Nigerian space. And if they can do that successfully, we are going to see the resumption of investment in FDI in Nigeria, because over the years, most of the FDIs that are coming into Africa, most of them have been avoiding Nigeria. We've seen the likes of Ghana, Togo, South Africa attracting FDI. And when we speak to foreign investors, the feedback we are hearing is that the political risk, the political uncertainty, and the structural deficit in the country is a major risk factor that is making investors, avoid Nigeria. So the current government and the federal government, in accordance with the state government and all major participants, should look towards addressing the infrastructural deficit, making Nigeria a more conducive place for investors and even locals to do business. And before you begin to see, cool money come into the economy, and that will drive growth for Nigeria on the long term, as regards relative to the FPI money, which is usually short term.
Yeah, the bonds market has been kind of quiet. I think last week the federal government did repay that $500 million for foreign bonds. But what do we expect in this second quarter for the bonds market?
Well, for the Nigerian Eurobonds market specifically, we're likely to see more interest in the market, simply because risk factors are moderating. Inflation is moderating across the world. We also have instances where central banks are, beginning to hint at, causing interest rate hikes, right? And these are all positive news for investors. So we're likely to see investors take on more risk in Nigeria. And on the Eurobond market as well, investors are already excited about the new policies that are being rolled out. Speaking largely of the FX, the fuel subsidy removal, which on the long term is likely to lead to cost savings for the government, and that simply means that the government has more ability to service external debt. So investors are pretty much optimistic about this, and we're seeing interest. That interest is likely going to be sustained across the rest of the year. For local fixed income space, the market has been hindered. Let me say, the market has been affected largely by some policy constraints and inconsistency that has affected the ability of fixed income traders to actually speculate, right? And this has happened since 2022 when we had issues like frequent CRL debits and what have you. So that market has been really calm. But lately, since the new administration has started implementing a much more market-friendly, opened up policy, we're beginning to see new reforms in the capital market that are enabling investors in that space to speculate better. And we've seen positive reaction over the last 20 to 25 days as the yields in the fixed income market have actually moderated, to a large extent. So going forward, we still think that fundamentals are largely going to play out in that space, coupled with the fact that buoyant liquidity would also drive yields downward. And the government has hinted that they want to run a low-cost government, in the sense that they want to reduce interest rates so that the debt service of the federal government will reduce. And if that is coming on board, coupled with the fact that investors are looking for more return in terms of capital appreciation, we're likely to see the local fixed income market moderate positively, and investors will likely record gains in that space.
So how would you advise investors to position for the second quarter?
There are a lot of opportunities across, assets. But let me start with fixed income. Fixed income has, in my opinion, or in our view, has more potential because fixed income is largely interest rate sensitive, right? And we are currently in a period where, monetary authorities across the world have reached their interest rate target, and they are considering, pausing, and then they are also looking at a further reduction in interest rates in the coming years. And if this happens, fixed income market is largely going to be a major beneficiary of that event. So, investors who are looking to take risk are advised to start taking position now, because, we've reached the turning point in terms of the current financial system trajectory. We've reached a turning point, so investors should position ahead of that turning point. Also in equities, equities still offer investors the opportunity to earn return that are more than inflation levels. So investors should also carefully invest in that space. And lastly, I must say that investors should also consider diversification, as they can begin to explore asset like mutual funds and ETFs to diversify and balance their risk in 2023.
So what we saw our U.S. inflation taper, and of course we saw the markets react to it. What do you see as the global and then the local themes for the market in the second quarter?
Well, for the U.S. inflation, right, the numbers have been really, really exciting. We started inflation from about 5-6% here in the year, and we're currently at 3%. So that's a positive number for the U.S. Fed and the U.S. investors in particular, and that has translated into gains across different asset classes. We've seen interest spiraling in fixed income, equities, tech stocks all jumping. We've also seen interest in digital assets such as cryptocurrency. So that downward trend in inflation has really, really improved risk on sentiment, and we're seeing interest flowing across board. The only issue now is that some market participants are a bit edgy, because the Fed, despite the fact that inflation is moderating, the Fed is still showing some signs of wanting to increase interest rates to completely tackle this current phase of inflationary problem. So that is some of the risk that is affecting investors playing fully or making us returning into a fully bullish market. And for the local space, inflation is still likely to trend higher. I mean, and that will be largely driven by food and energy inflation, because the pass-through effect of the subsidy removal is likely going to affect prices upward, and businesses are likely to transfer this cost to consumers. So we still see inflation tracking higher, at least for now, given the fact that we're also in the planting season. And I mean, for the most part of the year, we see inflation trending higher, given that the factors driving inflation are still, around the corner. And the Central Bank of Nigeria, might not likely take the same direction that the Fed is taking, because in Nigeria, inflation is not largely driven by demand side factors. Most of our inflationary challenges are from the cost push side. So in terms of the policy direction of the Central Bank of Nigeria, we don't think that the bank has a stronger chance or a stronger leeway to increase rates higher. However, we see them maintaining rates or trying to even reduce rates in line with economic growth in the second half of the year.
All right, thank you so much for those insights. Mr. Babajide Atolagbe, Portfolio Manager with Afrinvest Asset Management. Do have a great weekend.
Thank you.